the euro area. You've seen the euro go from 1.4 to the US dollar to now 1.1. It went close to parity. What have they done? Stagnation. They're caught between a rock and a hard place. They're trapped. Central banks cannot go and suddenly become hawkish because market reaction is going to be even further. Governments are super happy with inflation, bloated fiscal revenues, higher level of government spending. The government presents itself as the solution to inflation, the Inflation Reduction Act, which was in fact the Inflation Perpetuation Act.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman, I'm the EdJR mining guy over on X, and of course your host of this channel, and I'm looking forward to welcoming a first-time guest to the program. It's Daniel Lacalle. He's the chief economist over at Tressis, and I'm really looking forward to getting his insights, because he's also an educator, he's a professor of economics, or global economics, so he will be able to give us a really holistic picture of what is going on in the world right now, in the world of finance, in the world of economy, what impact, what damage are the tariffs doing right now? And I'm saying that carefully, but in terms of damage, maybe something good comes out of it. We'll have to see. Hindsight is always 2020 when it comes to those decisions. Really tough to assess on the spot. A lot of emotion, and I'll definitely discuss that with my guest here. We'll also have to discuss bond market. The 10-year yield has been exploding higher, almost 10% overnight, and we have to address that. Is it just because of a weak bond auction, or is there more to it? So, lots to discuss in the next 40 minutes. If you enjoy this type of content and the conversation, please leave a like, leave a comment, and hit that subscribe button. Helps us out tremendously, bringing phenomenal guests like Daniel onto the program. Now, without much further ado, Daniel, it is great to have you on the program. Thank you so much for joining us.
Thank you so much, Kay. It's a great pleasure. Thank you for inviting me.
Yeah, really looking forward to this. I keep saying to my audience here, is like I learn just as much as they do, because that's why I love these conversations, because they're very, very educational. And Daniel, we have to start at the very top here and get your see where your head is at. Maybe we'll start with your assessment of the economy and the financial markets as of today. Where do we stand?
Let's start with the economy. No, the economy has been weakening for quite some time, and the weakening underlying economic figures from the private sector were bloated by ever-increasing government spending. We ended 2024 with the economy of the United States with the worst growth of GDP adjusted for the increase of debt since the 30s. We have seen how this Keynesian way of addressing economic growth has been exceedingly negative for the middle classes. We have seen credit card debt soaring, real wages stagnant, very, very poor productivity growth. All those elements were very, very evident already in 2024. However, in 2024, markets were soaring. We had more than 70 nations with elections. What does that mean? That means 70 countries spending like drunken sailors. So what ultimately ended happening was that money supply growth exploded in 2024. And at the same time, central banks took the very aggressive and negative decision of starting to cut rates and delay the normalization of the balance sheet in a year of exceedingly high government spending and very loose financial conditions. Gold was soaring, which was already an alarm bell that policymakers should have looked at, because it was already telling us that the monetary destruction that was happening in the fiat world was absolutely crazy. Now, imagine a market that hears from central banks that we're going to have 4, 5, 6, 7 rate cuts even in 2025, that sees rate cuts in 2024, that hears constantly the idea that inflation is under control, and at the same time sees the economy slowing down, so expects some form of quantitative easing in 2025. The level of optimism in markets was so high that we saw the German equity market soar despite an economy that was worse than stagnant. Same with France, same with Japan, same with the United States. Markets exploding, an enormous level of complacency. And suddenly, In January, central banks start to get cold feet. They start to say inflation is persistent. We may not cut even one time, etc. So we have a number of catalysts that start to burst the confidence and the optimism and the exceeding level of leverage that market participants were taking to be taking that wave of optimism. That started with the blowout of the DeepSeek thing with technology companies. Immediately, the biggest longs and most levered longs suddenly declined, and then we had the tariff tantrum, as I call it. No, we have the tariff tantrum, and that basically just brings a catalyst that sends margin calls all over the market in commodities, in bonds, in equities, almost at the same time. No, so that is obviously, unfortunately, where we are right now. But I place the blame in the excessive optimism infused by central banks on markets in 2024.
That was brilliant. I have to admit, that was really cool. I took 2 pages of notes just there. Really, really cool, Daniel. Really appreciate that introduction. Of course, lots to follow up on now and dissect a little bit. And I don't even know where to start, but maybe we'll start with the central banks. You said they've been flat out lying. Let's call it that, I think, in terms of what they've been announcing. Everybody knows the inflation numbers were bogus. I think we all felt it. We all saw it. But the point is now, we're at this point today. The question is how much or how far, or what's the right question here? The central banks are trapped. And we all know what trapped animals do, for example. They bite and get aggressive. The question is, how will the central banks now act here, Daniel? What are your thoughts? How will they try to steer out of this crisis?
Well, I think you've said the perfect definition. They're caught between a rock and a hard place. They're trapped. No, central banks cannot go and suddenly become hawkish because market reaction is going to be even further negative, and that can create very significant damages in the financial sector, in banks. It can lead to very significant disruptions. No, on the other hand, they cannot be too dovish because financial conditions continue to be exceedingly positive. The inflation is not under control, so they need to give a very strange message, which is we're going to pump all the liquidity that we need, and we're going to keep rates in negative real terms, but at the same time, we're going to be very strict on inflation. And I think that I think that that's why markets are so choppy. What everybody's starting to realize is that they are going to continue to bail out government debt, and that they will leave inflation as a sort of secondary objective. Furthermore, even better now that they can blame inflation on tariffs instead of central bank monetary easing.
Yeah, it's an interesting discussion to be had because QE obviously will push inflation higher. There's no doubt about it. It's not under control, inflation. You said it just now. It is not. It has been rampant. Maybe do the markets understand what's been driving inflation higher? Do we even understand what has been driving inflation higher? Because besides egg prices and the bird flu, I think we can sort of take that out of the equation. But in general, what has been driving inflation higher in general? Is it just a deglobalization, the de-dollarization trend? Like, if you were to pinpoint it, because I don't think even Powell and the central banks understand why inflation is still persistently higher. Personal wage growth around 4.5%, maybe that has something to do with it. I'm not trying to put words in your mouth here, Daniel. I'm just curious. Do we even understand why inflation is persistingly high despite QT and other measures?
It's interesting because the narrative is that central banks have been hawkish and therefore very focused on reducing inflation. Inflation is always a monetary effect, always. All those elements that you have rightly mentioned are not causes but consequences of inflation. So what is driving inflation is the following. In 2020, governments and central banks decided that because there was no risk of inflation, they could increase money supply without any control, and at the same time not worry about inflationary pressures. They did, and they created more money. Developed economies created more money in the period between March and October of 2020 than in the preceding years since the Bretton Woods agreement. So, first, enormous increase in money supply. Second, when the economy reopens, governments, instead of reducing government spending and reducing deficit spending, decided to go all in and increase government spending and increase deficit spending, therefore creating further inflationary pressures. What that generates is an artificial, completely monetary driven demand boost that would have been addressed rapidly in an environment in which money supply growth would have been relatively stable. However, in 2022, everybody realized that inflation was not transitory, but it was persistent. And therefore, we had in 2022 a massive bond tantrum. And central banks panicked. They said, we cannot tolerate this. We cannot have a financial crisis again. So we need to continue to drive liquidity further in order to at least keep markets calm and expecting that inflation would be rapidly decreasing because of all the different aspects that you have mentioned. But none of them are causes. All of them are consequences. So in 2024, in that period, central banks said that they were very hawkish, but they were actually not. The reduction of the balance sheet of the Federal Reserve was actually less than half what they had announced. And that means more money printing because it goes in levels. It's cumulative. And hence, what happened was that in 2024, we saw exactly what we just mentioned. Massive increase in government spending because of elections, massive support from central banks cutting rates when inflation was still persistent. In fact, almost all the disinflation that we saw in the previous months had been due to a completely external factor, which was the energy component. No? So all of those elements drive persistent inflation. Inflation is not a coincidence. Inflation is a policy. And obviously, governments are super happy with inflation. Bloated fiscal revenues, higher level of government spending. The government presents itself as the solution to inflation, the Inflation Reduction Act, which was in fact the Inflation Perpetuation Act. No, all these things. So that's why we have persistent inflation. Central banks have indicated that they were hawkish, but they were not even close to be hawkish, especially after the enormous level of monetary intervention that they implemented between 2020 and 2021.
What I'm trying to figure is like, how do we get like, I think we know, like in general, we know how we got to today. But one question that sort of came to mind is a QT, the reduction of QT from the last Fed press conference. I'm not sure it got enough attention because I think that was quite pivotal in what Jerome Powell has been saying. And I think the mainstream media sort of brushed it off, not really understanding what's been going on there. Because it's a form of QE, let's be honest. By stopping QT, you are easing. Exactly. And the 5 trillion is, I think, more cosmetics and putting lipstick on a pig than anything else, because he could have just said zero, but that zero would have woken people up. So the question is, what's the impact here? How are we seeing this? And is that any factor of what we're seeing in the bond market, for example, today?
Okay. What we're seeing in the bond market basically is a double-edged sword. On the one hand, concerns about persistent inflation, which we addressed, and on the other hand, the concerns about the confidence in the monetary system as we know it. Because historically, US debt, European debt, was the reserve asset for central banks all over the emerging economies. But with the tariff tantrum, with the constant erosion of purchasing power of the currency, and with persistent inflation, what these central banks have found out is that holding treasuries and holding European debt actually didn't work. And in fact, what we have seen is what is happening right now with bond markets is a direct consequence of 3 consecutive years of losses at the central banks. So ultimately, what is going on in the economy is quite far away from the tariff tantrum, and is quite closer to what it has been going on, which has been that central banks and governments have been ignoring all the alarm bells in terms of the limits to expansionary policies. No, they have ignored the deficit limit, they have ignored the economic limit, and they have ignored the inflationary limit. No? So when more debt was actually leading to higher, not lower inflation, when more debt was leading to worse, but not better economic growth, and when more debt was leading to worsening fiscal situation in terms of deficit and in terms of interest expenses, not better, all of the alarm bells started to ring at the same time. And what we have right now is, on top of it all, you just put an icing on the cake with the tariff tantrum and the tariff war, which is obviously like the next nail in the coffin of sovereign debt as the world reserve for central banks and their asset base.
Yeah, it's an interesting debate because maybe I'm too naive, quite honestly. You would think somebody in Washington might have figured out that, well, all the $2 trillion deficit spending is not really leading to 3% GDP growth. It's just a hoax, right? Like,
Exactly.
why? There are a lot of people, like pretty much everybody smarter than me, to be honest, but in that regard. But why weren't the alarm bells rung at that place? Like,
Well, because they
it seems
benefit
too late.
from it.
Yeah, okay,
Because
good
they
point.
don't care. Obviously, if I'm in government, and I'm constantly increasing deficit and debt, and GDP obviously is bloated. I mean, if you increase the deficit by 2 trillion and you don't increase GDP by 1.7 trillion, it's because you're stupid. GDP is such an easy aggregate to manipulate, through government spending and debt. So from a government perspective, it was a very typical Keynesian policy of trying to bloat headline figures of GDP, of employment, so that they looked very, very positive, and passing the bill to the next. So the alarm bells were there. We had 2022, a disaster in the bond market. We had in 2023, we had a recession. Remember, we had a recession, and what did they do? They changed this is
It's like,
fascinating.
no. We got to just change the definition here.
They changed the definition of recession so that it would fit the narrative of high growth and positive economic development. No, bond yields soared to 5% in September 2024. All those things were brewing up. No, but it's like a pressure cooker. No, in which somebody is saying, look, the temperature is rising, but somebody else is saying, you know what, let's turn up the heat a little bit more, because I'm going to pass it to the next. And why? Because and you obviously could ask, why would they do that? Because they were running for the election, and they could actually have won the election. No, 2 reasons. One, if nothing happens, you continue to bloat GDP and you continue to disguise the weakness of the economy. Number 2, from a Keynesian perspective, if what happens in the market right now had happened under a Democrat or a Social Democrat administration, what do? You increase government spending, increase debt, and increase taxes. You see? Is that you create the problem and then you present yourself as the solution. Okay.
Yeah. Okay. No, that's that's just insanity. I'm sorry. It's like I struggle with that concept in general, but no, I appreciate you pointing that out. I quickly want to share something. It's just a 10-year bond chart, of the last 6 months here, and you're aware of it. What I just want to highlight is really the drastic move north. Towards 4.4. Like right now, the 4.4% is not really the problem. The problem is the move higher. The question is what broke here, Daniel? Like how can we interpret this rapid move higher, 3.9 to 4.5 almost? How do we interpret that? That's a quick, rapid, violent move.
Yeah, a few things. No, first, worrying decline to 3.9%. We're talking, remember, persistent inflation, etc., elevated levels of debt, etc. How can bond yields go from 4.9% in, in March, I believe, to 3.9% so quickly? Second, burst up as the debt and the inflationary expectations continue to be the same. No. So um, I think it's basically a very aggressive move in the bond market that is indicating that all is not well in the mighty dollar world. And that the administration that is talking about reducing the deficit and reducing the trade deficit needs to be a lot more concerned about the bloated level of deficit and debt and the declining demand for U.S. Treasuries, because you and I were talking before about the relatively weak demand for Treasuries in the last auction. That is already indicating that the world is not in a risk-off environment, should be piling up on treasuries and piling up on sovereign debt, and it's doing the opposite. And what we're seeing actually is happening also, not just in the United States, it's happening in Germany, it's happening in Japan. Germany and Japan bonds, which in an environment like today should be the safest assets in the world with gold, actually are behaving in actually almost the opposite way of how they should be behaving. I think that is another indication that sovereign debt from developed economies is not as safe a reserve asset as people thought for the past 30, 40 years.
Yeah, just looking at the price action, only today, gold is the only asset class that is performing, that is
Yeah.
doing well and preserving wealth. We'll find out. Hindsight is 2020. We're looking at a short window here. But as of today, gold is the only asset that's performing, which is really interesting and telling, of course, because it has been running like crazy. And we can talk about gold in a minute here, Daniel. But first, I just quickly want to get to something Ray Dalio said, because he warns investors are too focused on tariffs and not paying enough attention to the breakdown in major monetary, political, and geopolitical orders. So my question is, Daniel, and I've asked that Francis had earlier, are tariffs just noise, and where's the signal? Like, what are we making of this? What's happening in front of us right now?
Tariffs are an important catalyst, but are an important catalyst and a consequence of what Ray is saying. I don't agree completely with his view, which is actually very benign on China, but that's a completely different view. I'm not going to debate his analysis, but his analysis is correct in the sense that everything that we have been talking prior is indicating that the world is changing from what used to be a monetary spectrum in which a trade deficit and a fiscal deficit of the United States was basically a conduit that would create opportunities for central banks all over the world to increase their asset base with US treasuries and conduct easing policies in their own domestic currency. No, so the well-known US dollar carry trade. Okay, and that has broken, and by the way, has broken not months, but a year and change before the tariff tantrum. When did it start to happen? I remind you what I said before: 3 consecutive years of central banks with losses. That means that central banks all over the world, China, India, Russia, etc., all of those stop looking at Federal Reserve, at federal debt and in developed economies debt as the asset to have in their balance sheet and start looking for gold. And we saw demand from central banks soaring while demand for treasuries was actually weakening, not plummeting, but weakening. No? So those things are showing you that the world is breaking in two. The world is breaking into a US-centric world that will continue to have the US dollar as the world reserve, as that world's reserve currency, but in which the United States does not afford the luxury of having the enormous trade and fiscal deficit that it had when the world was awash with dollars and everybody and nobody had enough of it. No. And on the other side you have something new, and we don't know how that's going to play out. We have a new financier of first resort that doesn't attend to the same principles of investor security, legal security, and monetary security that we have been used in the Western world or in the old world order. That is China. China is lending in a completely different way to other countries. China is addressing monetary and commercial relationships with other countries in a completely different way than the Western world has done. And we don't know how that is going to play. But what we know is that most of those nations that are circling around China stop looking at the US dollar or the euro as the reserve asset to have to hold their currency. They're looking at other options. They're looking at gold. They're looking maybe at what I call the yuanization. Everybody talks about the de-dollarization. There's no de-dollarization. That's going on. That is all right. But what I do see is that Brazil, Russia, Indonesia, India, all those countries may actually start to use more the yuan, not create a new currency. That would be impossible technically and legally, actually, in many cases. No, but to be more dependent on China as the lender of first resort. So we are breaking the world into two lenders of first resort, the United States and China. Therefore, the United States and China cannot have the same situation that they had before of cooperation in trade and in the monetary world, because China is using the excess dollars it receives from its enormous trade surplus to break into a new world, therefore hurt the Western financial and investor system. And the United States cannot afford to have the MMT Stephanie Kelton beautiful world of deficits don't matter, debt doesn't matter, just spend and borrow and it'll all be fine.
No, it's an interesting perspective, of course, and it reminds me of what I'm seeing in the Congo right now with the U.S. and China sort of clashing, because the U.S. is offering military support while China is more the infrastructure approach in Africa.
Yeah.
In general, it's an interesting philosophy which is now clashing, right?
Absolutely.
U.S. military might, which it might not be able to finance in the future, and just announcing $1 trillion budget for the Pentagon. Just sort of shows where the focus is. Instead of investing in infrastructure, they're investing more into the military complex. Really interesting. No valuation from my part, but it's an interesting philosophy. It's two different philosophies here.
I think you're absolutely right. I think that we're living into and what's dangerous is to try to second guess where it's going to lead to. The only thing that we can actually monitor is what is actually happening, and therefore pay attention to the alarm bells. And I think that both Ray and ourselves in that area, we might have a different view about the outcome. That doesn't matter. It's to be aware of all these alarm bells.
Yeah, no, it's an interesting development, and of course, hindsight is always 20/20. But it's really, as you said, it's really difficult to predict. One question, Stephen Marin, of course, he's come up quite a bit in recent weeks and just the last couple of days, actually. A user's guide to restructuring the global trade system. When it came out, and Scott Bessent was using it, it was called the Mar-a-Lago Accord. Everybody's like, "Oh, this sounds brilliant." Now, the last 48 hours, everybody was like, whoa, this is the worst thing I've ever read, and this doesn't make any sense. you shaking your head, so I'm curious what your thoughts are on this whole thing, and maybe debunk it a little bit for us there, Daniel.
Well, to start with, the idea that artificially weakening the currency is going to solve your trade and fiscal problems is such a ridiculous idea that can only be viewed by people that have no idea about markets and that see things from a political view. Because if that was the case, Argentina and Venezuela would have solved their problems decades ago. So let's start with the reason why the Trump administration was voted was to lower inflation, was to address the enormous imbalances of trade and of debt of the US economy, to fix the US economy. You don't fix the US economy by devaluing artificially. That actually does increase inflation immediately, because you're destroying the purchasing power of the currency. No? Second, if this concept of the Mar-a-Lago Accord is basically a bully's view of success, is, oh, we're going to devalue the currency and we're going to force our trading partners to take long-term debt, because if not, we're not going to give them financing. Well, you're going to destroy the confidence in US debt if you devalue the currency and force long-term debt. The euro tried that, by the way, and it was an absolute nightmare. Why? Because if you're a bondholder and the way to address the fiscal and trade imbalances is to devalue artificially the currency, then why are you going to buy long-term debt when you know that at some point in the next 4 or 5 years, somebody else is going to do it again? You see what I mean? So the issuances of long-term debt become scarcer, and people at best continue to buy shorter term debt, which makes it even more unsustainable. Furthermore, when you devalue the currency, you don't solve your trade problems, because imports go through the roof in real terms, because at the same time, the fiscal problem worsens because government programs are elevated in to address real terms, i.e., they're elevated by inflation, while the income is actually worsening in real terms because you are impoverishing the economy. The Mar-a-Lago Accord is apparently based on something that actually never happened. No? Which was the idea that in the 80s, the devaluation of the US dollar went and solved the fiscal and trade problem of the United States. None of those two things happened. So the only way that what people need to understand is that a strong economy does not need a weak currency. That a weak currency is not a tool for growth and for reduction of debt, but a tool for cronyism, and that impoverishes everybody. So the Mar-a-Lago Accord, which obviously doesn't exist, and I'm being told all the time by people in or close to the administration, is pure nonsense that has been sold by some media. But if it existed, is a completely ridiculous idea that somebody as knowledgeable about economic history and about markets as Scott Bessent should debunk in a nanosecond like I just have.
Yeah, no, it's interesting because it was hailed as like, oh, this makes a whole lot of sense. We got to devalue the US dollar, exactly as you said. But it feels like they're trying to have...
Think about this. If devaluing the currency or weakening the currency was the solution, Japan and the euro area would be right now thriving. The euro area, you've seen the euro go from 1.4 to the US dollar to now 1.1. It went close to parity. What have they done? Stagnation. Ultimately, a devaluation is the following. A devaluation is an enormous transfer of wealth from the productive sector to the government. So it's an enormous and unfair taxation that is literally stealing the wealth created by the private sector to disguise the problems of the public sector. But the public sector, when it is able to disguise its problems, tends to do what? Increase them. Of course.
Can I ask you a bit of a what do you call it? Like a cheeky question here? Maybe turn this thing around. So I'm in Germany. You're in Spain. Let's assume the euro was stronger, and Germany is an extreme export nation. We all know that. We're really export oriented. But if the euro was stronger, wouldn't we be worse off right now? In general, because nobody would be able to afford our products right now. or
I
the
don't
last
agree.
5 years, for
I don't
example?
agree.
Maybe it's just turning this around. So I'm curious. I'm just
Yeah, no. I don't agree. We have seen uh, Germany became a world global leader in exports with an with one of the strongest currencies in the world alongside the Swiss franc, with the Deutschmark. Um, the euro is relatively weak to the US dollar, but it's not weak against most currencies in the world. It's actually pretty strong relative to most currencies in the world if you look at the performance. Therefore, the idea that you're going to compete by devaluing the currency with the rest of the world is easily debunkable, because there's always somebody else that's going to be able to destroy their currency faster and longer. Huh? So and think about this: the euro area has not had a problem on the export side. Where it has had a problem by having a weak currency has been where? In the fiscal side. Everything connects. Everything connects. It's a no growth. It's a no growth area with strong companies, tremendous talent, great entrepreneurship. So the risk of using a weak currency is that transfer of wealth to government, is that you're basically just at the same time subsidizing with the wealth created by the private sector an enormous administration that is constantly going to erode the productivity and the growth of the real productive economy, which is the private sector.
No, I really appreciate you humoring my question there, Daniel.
Of course.
Imagine the following. Your phone rings right now. Donald Trump is on the other end. He's calling, Daniel, my team screwed up. I can't help it. We're looking horrible right now. The market hates us. Help me. What would you suggest?
I would say the following. Mr. President, you are a negotiator, and as far as I know, you win. No? Start showing success. Start showing success to the world. Start showing that you're a negotiator, not a protectionist. Start showing that you are looking to improve the inflation problem of the United States and the debt problem of the United States, and not create a protectionist 30s economy. So go out and show 1, 2, 3. There's already 70 nations apparently in negotiation. Start showing day after day. New trade deal with South Korea, new trade deal with Mexico, new trade deal with Argentina, new trade deal with El Salvador, new trade deal with Chile. You see what I mean? And so the reason why people are scared is because they don't believe that Donald Trump is what Donald Trump is. You see what I mean? Yeah. Everybody, for me, it's exceedingly clear, because I know I read what he has written in the 80s. I heard what he has said all the time, and I understand what he is trying to accomplish. But there's an entire narrative telling us that this is not the real case, that there's a hidden agenda, and that the hidden agenda is a Hoover type, Roosevelt type protectionism, and that is obviously going to derail the economy. Prove them wrong.
No, excellent answer. Really appreciate putting you on the spot like this. I really appreciate that. We do have to talk about the economic outlook for 2025, U.S. and globally as well. How do you see the rest of the year play out here, Daniel?
Oof. With all of the uncertainty about tariffs, I'm going to sound optimistic. I think that the ultimate outcome of the tariff tantrum is going to be very limited in terms of global growth. We will have lower global growth, but we were going to have lower global growth anyhow. Okay, so I think that that is. Could we have a recession? We can have a recession by reducing government spending, but that is not a problem as long as job creation and investment continue to thrive. I think that the trade negotiation of tariffs is going to end up in a massive inflow of investment into the United States. However, those don't play one to one, and they don't play day by day. Hmm? So my view is actually relatively optimistic, is that we will not have strong growth, but we will have a recovery that will be faster than the slump, if that makes any sense.
So hyperstagflation is the term I've been hearing a couple times today, actually. Slower economic growth, higher inflation, or just stagflation in general. Let's scratch that hyper out of it. But
Mm.
stagflation, is that what you're predicting then
I
for
don't
the
think that
next
there will
six,
be
12 months? Is that
I don't think that there will be stagflation. I think that the if the economy starts to slow down because of the tariff tantrum, prices are not going to go up. The only way in which prices will go up is if government spending, deficit spending, and monetary easing coincide, i.e., money supply growth soars and money velocity soars as well. Both things have to happen. Remember that in 2009 and 2016, we had money supply growth, but money velocity was actually declining. So if money velocity declines, and I think that that is pretty obvious, I don't think that we're going to see the risk of rising levels of inflation. Persistent inflation, yes, but not 5%, 6% inflation with negative real GDP.
in the interest of time, I'm going to ask you one last question because I know you're also an expert on the energy markets, and we've seen oil drop significantly here as part of the tariff tantrums, you call them. How much of an impact will oil have on the inflation dynamic?
Oh, a tremendous one, but not just oil. Huh? Natural gas is down 3.5%. Aluminum is down 7. Copper is down on the year, despite the enormous level of supply and demand challenges that exist in the copper market. So that is already telling you that there is more of a disinflationary impact coming from commodity prices, and commodities transfer to inflation very, very quickly into agricultural prices, into food prices, etc., etc. So, however, I don't think that the slump in oil prices is going to last an enormous amount of time. Okay, oil prices always overshoot on the upside and on the downside, and I think that right now the oil market has a certain level of oversupply, not too much, but the supply demand balance is adequate enough to bring oil prices closer to above the 65 $70 a barrel, no, but not strong oil prices. Think about this: we have not seen strong oil prices since the since the short burst of the Ukraine war, and then they declined. No, so I think that that is likely to continue to happen. That we cannot expect strong inflationary pressures from oil prices, but commodities may probably bounce to a more normalized level that brings it closer to the equilibrium level, which is closer to the 65 $70 a barrel.
No, fantastic, Daniel. We got to wrap it up here. What a wonderful conversation. I need to start listening to your Spanish language podcasts more and more. So I want to learn Spanish, but also I really enjoyed this conversation. So thank you so much for your insights. Where can we send our audience?
Oh, I think it's relatively easy to find me. I always say that it's easier to find me than to avoid me. Just put on Twitter Daniel Lacalle. I have an English language account. I have a Spanish language account. My website, dlacalle.com, also has Spanish and English articles. And I also have 2 YouTube channels, one in Spanish, one in English, and they have different content. So if you speak both languages, you can have either fun or end up very, very tired of reading and listening to me.
Oh, absolutely. No, really, really interesting stuff. The Spanish language channel, for some reason, is way bigger. Did you start it earlier?
Obviously, it started earlier, and my Spanish-speaking audience, Latin America, in the U.S. and in Spain is quite strong and quite active. Hopefully, we will bring that to the English channel pretty soon.
Fantastic, Daniel. Really appreciate you coming on the show here. Really appreciate your time. Thank you so much. And everybody else, thank you so much for tuning in here to Soar Financially. Really appreciate your time. Hope this was educational. I really enjoyed the conversation with Daniel. If you haven't done so, make sure to hit that like and subscribe button, but also make sure to follow Daniel. He's got some fantastic YouTube channels, some fantastic content, especially in the trying times, like let's call it that, and challenging times. It is good to stay educated and stay on top of things. What is the market up to? Where are things headed? So make sure to get educated. We're doing this for you, so we do appreciate the support in return. Of course, it's free to just hit that subscribe button. Thank you so much for tuning in. We'll be back with lots more. Take care out there.